Hello, good day. This is Salman, and this presentation is about the US markets, where over the past few months, many investors have noticed a disconnect. Even President Trump is vocal about this. We see strong economic data, solid growth, low unemployment, improving earnings, and yet the market remains flat or even react negatively. This presentation is about understanding why that happens, not from a headline perspective, but from a structural one. The key question is not whether the data is good. The question is what does good data imply in today's market environment? And as we will see, the answer has less to do with growth and much more to do with constraints. Before we begin, this is an analytical framework based upon public data, not a forecast or investment advice. Okay, let's get into the data. This is Act 1, the paradox. Well, strong data is resulting in weak markets. Let's see what has changed. Traditionally, strong economic data translated into higher earnings, expectations, and stronger confidence and rising stock prices. But today, we see a very different response, and this behavior confusing to investors because many investors are still using a playbook that worked when the growth was binding constraint. That constraint has changed. Strong GDP prints or payroll numbers are followed by flat markets, short-lived rallies, or even pullbacks. The important point here is not that the data is weak. It isn't weak. The real question, what does good data allow and what does it block in today's market? This chart illustrates this paradox well. Despite supportive fundamentals and clear positive trends, the market has struggled to break out of a prolonged range. That tells us something that has changed, not in the data itself, but in how markets interpret it. Well, what are the markets actually pricing? They are not pricing headlines, they price expectations. And more specifically, they price policy reactions. That's why short term interest rates and real yields have become more important for equity pricing than GDP itself. When new data challenges the expectations about inflation or policy, valuations move often more than earnings. This is the key regime shift. In the past, growth was the bottleneck. Today, growth is available, but policy flexibility is not available. As long as inflation constrains policy, good growth alone doesn't guarantee higher asset prices. Today, the markets are not constrained by growth, but by a stack of interlocking pressures. So, to understand market behavior, we need to stop looking at the data in isolation and start looking at what's constraining the policy. Services inflation has started to decelerate. It is a good news, but it has not stabilized at a level consistent with policy easing. Real services consumption is still growing, which tells us the demand has not broken. The dollar is holding up, reflects US relative strength and higher real rates versus other economies, rather than broad household prosperity. Real disposable income growth is only around 2% while year on year, while services inflation is closer to 4%, and real services consumption is growing closer to 6%. That gap, that suggests households are sustaining spending through a mix of savings drawdown, credit usage, and prioritization of services consumption. This dynamic can persist for a while, but it does not argue for immediate policy easing unless growth or financial conditions deteriorate meaningfully. But as Fed Chair Powell mentioned, this sets the stage for gradual policy easing in wait and watch mode. Services inflation slowing without demand breaking tells us policy makers that they can wait, and markets shouldn't expect easing unless something else breaks first. As supporting data, here we see very strong labor participation, so there is less free capacity if they need to scale. Growth in terms of utilization of human resources needs to come from tech or some other means. This supports higher real rates. Real rate meaning the nominal interest rate minus inflation. Over the past 20 years, US productivity growth has averaged about 1.4%, and over the last 10 years, about 1.5%. The recent pickup towards 1.7 is a cyclical improvement and not a structural break. At those levels, productivity is insufficient to offset the current wage growth, which explains why services inflation remains sticky and why policy remains constrained. Private credit markets show calm, and IG and HY credit is more or less at the lows. Shows confidence is high and liquidity is ample. In other words, this suggests a late cycle, risk restrictive regime, not a credit crisis. Because SOFR moves in lockstep with EFFR, banks and dealers can obtain secure funding at policy rates, indicating ample system liquidity rather than funding stress. Sluice tightening with calm funding markets is equal to banks can lend, but they don't want to lend to everyone. Based on Fed sluice report from federal government data of October, the system has enough liquidity, ample liquidity, but credit is being rationed by risk, trade exposure, and borrower quality. A late cycle risk managed regime rather than a funding or credit crisis. This brings us to the most important constraint here: services inflation. Goods inflation has cooled down significantly, but services inflation, the things driven by wages, remains very sticky. And because services make up a major part of the economy, this is what central banks focus on. As long as services inflation stays elevated, the policy cannot ease comfortably. Service inflation is ultimately a wage story. If wages grow faster than productivity, cost rise. And when unit labor costs stay elevated, inflation pressure doesn't disappear. It just slows. This is why inflation today is more persistent than many expected. Now, here is where things get subtle. Consumption is strong, especially in services, but real disposable income growth has been modest. That means demand hasn't collapsed, but it isn't accelerating either. In many cases, consumption is being supported by savings drawdown and balance sheet strength, not rising real income. This creates a dilemma for policymakers. Growth hasn't broken. Labor markets are tight. Services inflation is still above target. In that environment, easing policy too early risks reigniting inflation. So policy remains restrictive, not because the economy is weak, but because inflation isn't fully resolved. This combination tells us where we are heading in the cycle. This is not early cycle. It is not a recession. It's a late cycle, high pressure environment, strong activity, tight labor, calm credit, but rising constraints. Now we can evaluate the original question. When strong data comes in, markets don't celebrate, they calculate. Strong data indicates the possibility of higher rates, staying higher for longer, higher discount rates, and tighter financial conditions. So, the first reaction is a valuation pressure, not earnings optimism. If I can earn 4 to 5% in real adjusted returns with zero duration and zero earnings risk, equities must justify why I should take the risk. When credit is cheap and unavailable, markets needs to be selective. Let's start by comparing the real yields across major developed markets, the US, the Europe, and the Japan. In the US, the real yields have been clearly positive and elevated. Investors holding the US treasuries are earning a real return after the inflation. In contrast, Germany's inflation linked yields are much lower and far flatter. Even when positive, they offer meaningfully less compensation for tying up capital. Japan is the extreme case. Nominal yields have been suppressed for decades and real yields are effectively negligible. Cash parked in Japan preserves stability, but not purchasing power. This matters because global capital doesn't move based on ideology, it moves based on real risk adjusted return. When the US offers the highest real yield among large liquid investment grade sovereign markets, it naturally becomes the default parking place for global cash. The key takeaway: the US isn't attracting capital because it is perfect, it is attracting capital because the alternatives pay less in real terms. Now let's look at the shape of yields, not just the level. The US yield curve, especially in real terms, reflects something important: policy credibility. The markets believe the Fed will contain the inflation over time without destroying the currency. In the UK and the Europe, forward curves show more uncertainty, long dated real yields are lower, and inflation compensation is more fragile. Japan again stands apart. Yields remain anchored by policy, not by market pricing. That stability comes at the cost of return. For large pools of capital, for sovereign funds, pensions, reserve managers, this matters. They need liquidity, depth, legal certainty, and the ability to exit at scale. Only the US Treasury markets provide all those four simultaneously, while still offering positive real yields. The key takeaway is that US Treasuries offer not just yield, but flexibility and trust at scale, and that combination is rare. Additional data: cash yields are rolling over following policy, and the MMF are near all-time highs. Demand is not deteriorating despite rate reduction. Well, is the US still the favorite risk-free place to park cash? Yes, not because the US debt is small or policies are clean or politics are clean, but because no other markets currently offer higher real yields, comparable liquidity, credible inflation control, and a universally accepted settlement currency. Until another region can offer all four at the same time, global capital will continue to default to US assets. Summary: risk-free returns are attractive. T-bills and money market funds offer competitive yields with no duration or earnings risk. That raises the hurdle for equities. Stocks just don't have to grow, they have to justify why investors should leave cash. This is why markets feel confusing. capital isn't disappearing, it is becoming selective. Some companies attract capital easily, others struggle. Index level performance hide this dispersion, which is why the markets can feel flat even when many stocks are moving sharply. In this regime, the investors care less about revenue growth and more about earnings quality, pricing power, margins, free cash flow, and balance sheet strength matter more than volume growth. This is a typical late cycle behavior, not a sign of market dysfunction. Because dispersion is high, indices can be misleading. A flat index doesn't mean nothing is working. It usually means leadership is narrow and capital is disciplined. This is not a broad beta environment. This is not an early cycle breakout environment. It's a late cycle, high pressure environment where resilience and constraints can coexist. Historically, what works in this phase are businesses with strong balance sheets, purchasing power, real cash flows, and limited refinancing needs. In other words, resilience matter more than excitement. What struggles are highly leveraged models, long duration growth stories, and narratives that rely on cheap capital returning quickly. This isn't about pessimism, it's about cost of capital. Of course, exceptions are there where great narratives exist in combination with the above characteristics, even if they are a bit weak now. So when does this change? Good news becomes good again when the constraints ease. This requires three things: services inflation clearly breaking, rates peaking and real yields easing, and liquidity constraints improving. Not because markets changed, but because the bottleneck is removed. Markets aren't broken, they are constrained. Good news will matter again, but only after the constraints ease. Until then, strong analysis of businesses and macro environments will be the key differentiators of successful investors. Thank you.